We are now joined by Rajiv Bansal, the CFO, and to give us a flavor of the BFSI vertical and Europe, BG Srinivasan. Gentlemen, good to have you back on ETNO. Thank you for joining us. BG, let me start this round of discussion with you. And what do you want to start with, Europe or BFSI?
I'll go with both. Both have done well last quarter.
BFSI, so I will start with the big piece. Up 3%. Are things looking up? Because that is the basic bread and butter business for Infosys.
See, the overall sector, the financial service sector, definitely in the last quarter turned for the positive. Particularly banking and capital markets, we see as they posted their last quarterly results in the US, Europe, there is definitely a turn for the better in terms of their own performance. However, there is a lot of focus on cost optimization because when the revenue upside is challenged, everybody is focusing on driving efficiencies. And that is something which we continue to see not only in the last quarter, for the last couple of quarters, and we will continue to see that actions in the future as well, in the near future. But in terms of spending, definitely there is on one hand further vendor consolidation initiatives happening both in Europe as well as in the US. We are seeing discretionary spend, though it's not broad-based, selectively going into client-centric applications, analytics, the multi-channel. The digital transformation is big on the agenda for both banking and capital markets. We're also seeing spend particularly in the risk and compliance areas. These are the three distinct areas where we are participating in. Particularly when it comes to vendor consolidation, obviously we need to be on the right side. So as more and more vendor consolidation efforts happen, there is definitely on one hand a cost squeeze, but the revenue volume uptick will be there if you continue to win those deals. So that's our focus area. We've also added some new accounts in the sector, both in Europe, US, as well as in the rest of the world, which has also given us some uptick in revenue growth. We had some couple of large deal wins in the last quarter. We have seen deal activity, particularly in Europe, open up in the Nordics for financial services. Benelux has always been strong for us. UK, of course, UK and US continue to be strong. We work with some of the largest banks in Australia as well, and there again we have done reasonably well.
Rajiv, margins. The deal pipeline has picked up. Growth momentum is back. Rupee was a strong tailwind. But margins have been flat even if I knock off all the extraordinary.
That's true. I think we did say in our earnings call in July, saying that we are giving wage hikes effective July for our offshore folks at 8%. We are given on-site folks at about 3%, and we gave wage hike for our sales folks effective May, which was 8%. So if you look at the impact of all that, we had clearly articulated saying that it's going to have a 300 basis point impact on our margins for the current quarter. And if you look at the rupee depreciation over the last one quarter, on an average basis has been 11%, which has given me an uptick of about 250 basis points on the margin. But it has been negated by 300 basis point impact because of wage hikes. So to that extent, I think the expectations were very clearly set. I think we clearly articulated how wage hikes would pan out over the next 2 quarters and what the impact is going to be.
Rajiv, last time you told me that the margin trajectory had bottomed out. But now, has the uptick also started there?
No, I will say, look, we are in the investment phase right now. If you look at the last couple of quarters, we have seen volatile growth. And as you've seen, what we articulated in the last 4-5 months is clearly saying that we have to invest in the business, be it sales engine, sales effectiveness. We have to invest in product, quality, tools. And also at the same time, we have to look at our cost, and we are driving a cost optimization initiative. The fact is that these are the investments that we have to make to sustain a high quality growth, higher growth at good margins. And during the journey and during the initial phase of the journey, you would see the margins getting impacted because of investments, depending on which quarter you make the investments. But I think as long as the investments are happening, you have a clear plan on how those returns will come from the investments and how it secures your future. I think these are right investments to take. So I'm not too worried about the margins, how the margins pan out in the next 1 or 2 quarters. I think the important thing is to make the investments and still make the margins. And that is what we are doing right now. So I think if you look at the last 3 quarters, our operating margins have been flat at 23.5%. And I think that's a good sign because in spite of the rupee depreciating, appreciating, I think we have kept our margin profile at about 23.5% for the last 3 quarters. We are investing the money back into the business if you're seeing an uptake. And that has gone in terms of employee wage hikes. We are paying our employee better bonuses. We are investing in sales. We are hiring new salespeople. We are looking at growth markets. So I think those investments are the right investments to make.
Now, Shibu just told us that Q3 and Q4 are going to be soft quarters for the company. If the environment is going to be slightly soft, there are too many holidays, what happens to margins?
No, see, at the end of the day, margins is as a it will depend on how the growth is. Because if the growth comes down, I can't cut my costs because to a large extent in an IT company and
growth is coming back, so that is not a worry.
No, see, you have to understand. If your question was if the growth doesn't come, then what happens to the margin? So I'm trying to answer in that respect, saying that to a large extent, almost all your costs are fixed for the current quarter because these are wage costs. I can't cut salaries just because I don't see growth. So I think a lot of margins would depend on the growth coming back and the growth being there. But I think what I would say is that, these are soft quarters, as that's true because there are lesser working days. We'll always have a overhang of client shutdowns, furloughs during the quarter, holiday season. So to that extent, Q3 and Q4 have always been softer quarters. But as I said, I'm not worried about quarter-on-quarter margins at this moment. I think I'm more focused about what my exit rate of margins are going to be this financial year and how that will play out for the next financial year. Because this year is to a large extent to get the growth back, ensure that we actually invest in all the important things that we need to invest, get the employee morale up, get the attrition levels down, have a very effective sales engine, invest in quality and productivity. I think those are the important things for this year. And if we're able to do all of that, I think the next year would look much, much better for us.
So, PG, when will this growth come back? Will it come back in the first half of next financial year or second half of next financial year?
See, if you compare to last year, we are already on an upward growth trajectory. And we obviously internally we're making all efforts to sustain that growth momentum. Notwithstanding any new shocks in the market environment, we would want to continue to focus on driving this growth momentum into not only next 2 quarters, but also when we cast our plan for next year. So we are not letting go on the focus on growth for sure. And this is across all sectors, across all service lines. We're also investing a lot in our new growth engines, which is products, platforms, cloud, enterprise mobility, analytics. So our strategy is very focused on driving quality growth. If both the largest markets, Europe and US, continue to remain stable, and we will have a better idea when the budgets for our clients are cast in the month of January, we would be able to give you a better idea of how the next year would pan out.
Rajiv, you've taken a big charge of about 220 crores. Tell me a bit more about that.
No, I think if you look at our note in the financials, it's very clearly articulated. See, we are in discussions with the U.S. Attorney's Office and other departments for a civil settlement. And I think based on our assessment and based on the discussion that we have and where the discussions are at this point of time, we felt it's important to take a charge of about $35 million, and we have taken that charge. And I think a lot of details are there in the notes to accounts. If you look at it, there's nothing more to say at this point of time.
But is a strong currency environment helping you to take a slightly bigger leap, take a slightly deep dive, because you have little bit of more elbow room and a lot of flexibility?
Oh, absolutely. I think it has. If you look at it, it helped us give a wage hike this quarter. It has helped us make the investment that we need to make in the sales engine, all the investment that I was talking about. So that definitely gives you elbow room. But also you have to understand, a very volatile currency is not good in the long run. It's not good for anyone in the country, and especially for us too, because a lot of this rupee depreciation also impacts on our non-operating income, because most of our cash balances in the bank are in banks. We get interest, and interest when I convert back into dollars, I lose interest in dollar terms. So a lot of the operating benefit that I get, operating margin benefit that I see, actually gets negated to some extent by the drop in interest income in dollar terms. Also, this kind of volatility is very difficult to manage and take an effective hedge. And that we have seen exchange losses of about $14-15 million this quarter. So I think a lot of that benefit that you see also gets negative, and the rupee is very volatile. But definitely, if the rupee remains stable and it remains at this level, I think yes, definitely gives you a lot of elbow room.
The dividends what you've announced today with your Q2 numbers, is that in line with your dividend policy, or this time around you could tweak a dividend policy?
No, it is in line with the policy. We have a policy of...
I was hoping you would say a bigger number, maybe more than 33%.
No,
you're generating more cash, your reserves are going up.
No, if you change the dividend policy, we would come back to you and tell you that you've changed our dividend policy. As of now, the dividend policy remains the same. We'll pay up to 30% of our profits, and we are paying according to that policy.
Vijay, give me one concern. What is one factor which is giving you sleepless nights? Last time you were having a lot of sleepless nights. I'm sure the number of sleepless nights this time around are less.
See, if you look at the macro, definitely there is a fair degree of stability, so that's definitely not a concern. Couple of things which could impact us, of course, is the immigration bill, which is tabled in the US. That is something may not be a quarterly phenomenon, but that we're waiting for that outcome. There are some short-term challenges which are more to do with the client context, which we have already mentioned, furloughs and then holidays. Otherwise, we are not seeing anything major at this point in time.
Rajiv, just a one-word answer. If the overall confidence about in your business environment was, let's say, 5 out of 10 after Q1 numbers, has that gone to 7 or 8 now?
7.
7, not 9?
You asked me one-word answer, I gave you a one-word answer. So
okay, I'll take 7. 5 has become 7, which is encouraging. Would you say 7 or would you say 8?
7.
7. Okay, so 5 to 7, I think that is a mark of encouragement. Good luck, gentlemen. Appreciate your time, and I'll see you next quarter.
Thank you.
Thank you.